of crises or management of crises when they occur have an impact on the long-term behavior of the economy, particularly in terms of growth, in terms of consumption, output, wealth, etc., etc. And yesterday I was focusing more on cycles, short-term fluctuations of the economy. This time I'm looking at the long-term impact on growth. So that are the traditional questions that are asked in a macroeconomic model. So again, the math will be very simple, but I think that simplicity has its virtue sometimes. And one thing that we want to analyze is to differentiate the impact of different kinds of negative shocks on the economy. For example, recessions, where by recession I mean basically a decrease in productivity, a technological shock related to the literature that is called real business cycles, that is business cycles that are caused by exogenous technological reason. And I want to contrast the impact of those recessions or technological shocks on what I call crises, and it can be either banking crises or stock market crashes like Pete Kyle was presented yesterday. So it's important to have in mind that I was talking precisely. I was talking about you. So I was saying that there are two kinds of financial crises. You have banking crises, as you pointed out yesterday, and stock market crashes, and they have very different impact on the economy. So some stylized facts that we would like to explain, in particular the fact that there is a substitution between bank loans and bonds in a context of a crisis, and also a general increase in interest rates. And finally, there is another stylized fact that is important, which is the fact that bank leverage tends to be pro-cyclical. And particularly Adrian and Shin have insisted on this using recent data on US banks. Okay? So the important thing to take, even though we want to have a simple model, we want to capture the important features. And one feature which we believe is important is the fact that firms can use loans, bank loans, and bonds. So the growth of the economy will be fueled, if you like, by two types of financing, bank loans and bonds. Yes, Alistair?
When you say interest rates on loans and bonds, you mean the spreads against some government rate?
Yeah. Okay, so what we do, we develop a very simple equilibrium model with two types of financing, bank loans and bonds. It will be really an extension, a dynamic extension of the model I presented yesterday, one I wrote with Hans Gersbach, and I should have said that we have a third co-author, Martin Schäfer. The model is exactly the same spirit. Financial friction generates pro-cyclical bank leverage. And in the dynamic extension, we capture the impact of this pro-cyclicality of leverage on growth and also on the amplification of real and financial shocks. So we start by probably one of the simplest possible models in macro, which is the Ramsey model of capital accumulation. But here, instead of having only one type of capital, we distinguish two forms of capital, what we call informed and uninformed capital. And maybe, you could criticize a little bit in terms of measurement what we mean by informed capital, but in our interpretation, it's really the equity of the banks. And maybe we could discuss also the difference between inside equity and outside equity, which is also a limitation of our model. But the idea is that you have two types of institutions that finance the firms. You have financial markets, and it's the uninformed investors that provide money to the financial market. So it's, of course, a simplification because financial analysts play a big role in creating information for those investors. But roughly speaking, you have these uninformed investors who put their money in the financial markets, and informed investor, i.e. the bankers or the experts in the terminology of Brunnermeier and Sannikov. And it's important to look separately at the two stocks of capital. Instead of having one type of capital, we have two types of capital, and the accumulation of those two types of capital will be important in determining output and growth. And so what we find, in a nutshell, is that financial friction slows down convergence to the steady state, but also distort capital allocation in the long run. So the model will be really simple. At this stage, it's a deterministic model. But since it lends itself to a very simple numerical simulation, we can introduce shocks. And I will do that in the traditional methodology of impulse response. That is one shock that was unanticipated, but it's also possible to write a true stochastic version of the model. So one of the important things that our model predicts, and which fits quite well with the data, is the notion that different shocks, and basically we will distinguish three types of shock: productivity shocks, or traditional real business cycles, banking crisis, where a fraction of the capital of the bank is depleted because, for example, they have lost money on some speculative activities, or a stock market crash where it's the capital, the uninformed capital, that is depleted. And we look at the impact of these negative shocks on the economy, and we find that they have very different speeds of recovery. And in particular, this will suggest that some type of policy interventions could be justified, either ex ante, or ex post. That is, we will distinguish bank capital regulation, which is supposed to prevent crisis, and crisis management, ex post interventions, like, for example, capital injections. Okay, and we will focus more on this.
That's fine, I thought you just switched off.
So again, there is an important literature already, the famous DSG models, and they have introduced the banking sector, and they look at the impact of financial frictions. So in particular, Gertler and co-authors, Kiyotaki and Karadi, have looked at the efficiency of monetary policy. Angelo Nifaya, Mayan Moran, Rampin, Viswanathan look at the role of bank capital in the propagation of shocks. And also Adrian Boyarchenko and Brian Marsenkov look at bank leverage cycles and crises. Here we do a different type of thing. Well, first of all, a parsimonious model, where we look at the long-term impact of financial frictions. And the objective is really not to guide monetary policy or to study credit cycles like I studied yesterday. Rather, we want to derive policy implications for financial stability, as I said, in terms of crisis prevention and crisis management. And again, this is preliminary and incomplete, so your comments are very useful. Okay, so let me start by the model. As I said, it's a very simple model. It's a really Ramsey model, a classical workhorse of growth theory, where we have two goods: consumption, which can be used also for investing in the technology. So the consumption good and the capital good are the same here. And you have labor. And we have two sectors, like yesterday. You have large and mature firms that can be directly financed by bonds, and small and young firms that can only be financed by bank loans. And like in the Ramsey model, there is some capital depreciation, which means that you have to invest if you want to maintain the same level of capital. So there are four types of agents, all are competitive. Workers, each of them supplies inelastically 1 unit of labor. Entrepreneurs, who manage the non-financial firms. Bank investors, who own the uninformed capital, omega T. And bankers, who manage the banks and own the informed capital ET. So the two variables of interest here, the two state variables, if you like, will be ET and omega T, the two types of capital. So there are no, for the moment, no shocks. The productivity is given, but ultimately the objective is really to introduce stochastic shocks.
So what's informed and uninformed?
So it's the terminology we use. We mean that there are two technologies for financing firms. Either you use the market, and then you don't monitor the firms. This is what I call uninformed. So it's basically if you want a proxy for omega T is the size of the bond market or the size of the financial market. And the proxy for ET is the capitalization of the banking sector. And the size of the banking sector, like yesterday, will be determined by the sum of equity capital and the deposits that are collected by the banks
from investors.
And again, the investors will have the choice between putting their money into the bond market or putting their money in the bank, and since they are risk neutral, they will require the same expected return on both. Okay, so it's really the same structure as yesterday, except that now we look at the long-term impact of shocks.
Excuse me, and
Yeah.
with respect to workers and entrepreneurs, can these swap categories between workers and entrepreneurs? So can workers become entrepreneurs here?
Oh no, unfortunately, it's a very simple model where the poor workers have to work, and entrepreneurs are different experts. But it would be interesting to endogenize the occupation, but it's another paper. Okay, so at each period, agents decide how much to consume and how much to save. And again, important thing is the total allocation of capital, which was fixed yesterday. Yesterday we had 1 unit of capital, and the question is how to allocate it between the two sectors. Here we have KT, units of capital, but we distinguish the two informed and uninformed capital because they will have an impact on the allocation of this capital to the two sectors. Because ultimately, what matters is how much capital will be obtained by the sector M, that I call M, the firms getting market finance, and the sector that I call I, firms needed intermediated finance. So the amount of capital here will be the result of the equilibrium between banks and financial markets.
So there's quite a sharp distinction between the two sectors. So the firms that rely mainly on market finance, they can't go at all to the banks.
That's right.
Even though in the real world, relative prices might change, and they might prefer some more bank finance.
That's right. If you like, here, bond prices will be, or the return on bonds will be always lower than the interest rates on loans. So which means that if you don't need banks, you always finance exclusively on bond markets. So in the real world, some firms use mixed financing. And this is captured, for example, in the Holmstrom and Tirol paper, where they have this moral hazard in chain, and where the bank lending serve as a sort of certification on the quality of the assets which is used by investors. We don't have that here. Okay, so we take the usual Cobb-Douglas technologies with the same exponent alpha. And the TFP, the total factor productivity here, will be constant, but actually we can put some shocks in it later. And the more important thing is that there is a specific productivity factor here, which could also be stochastic. And the reason why we use this is because in different countries, you have very different sizes of the banking sector with respect to the financial sector, like the US, for example, banking sector is small. In other countries, in continental Europe, it's bigger. So we want to be able to calibrate different sizes of the banking sector vis-à-vis the financial sector. And we introduce this specific productivity factor that will, in our model, explain different sizes, okay, of the financial sector. Of course, there could be other explanations for the different sizes of the financial sector, but this is.
So here, what is L?
So L is labor. So we have, we also have, segmented labor market. So it's also an important assumption. Instead of assuming that the workers are free to choose in which sector they work, we suppose that they are specialized.
But so there are two sectors only, right?
Yeah.
I and M.
Yeah.
So in what sense do workers get? So these are two investment channels, in fact.
Yeah.
They're not. They can end up investing in the same sector or lending to the same firms. So where do the workers come? I'm not sure I understand. So there are two channels of investment, right? So
Yes.
they can invest either by buying bonds or giving their money to the bank who then
Right.
gives loans.
Right.
But these loans may be given to the same firms that the firms who issue bonds. So why do you distinguish? Where do the workers really come into this?
Which is because we assume, maybe in finance it's not so common, but we assume that to produce goods, you need workers.
Yeah, but so LJ is exogenous. L is exogenous.
L? No, not at all. L is given by the equilibrium of the labor market.
Okay, so there is a connection at the end.
So if you like to be more specific, we will have four markets actually. There will be the capital market, the loans market, the credit market, the financial market, the labor market, and we assume that the labor market are segmented. Okay, so there is a fixed labor supply, but the wage rate will be determined by the marginal productivity of labor, and the marginal productivity of labor itself depends on the allocation of capital between the two goods, between the two sectors.
And there are two types of industries: financed by market,
Exactly,
financed by law.
exactly.
Okay.
So labor is specialized, but capital is not.
To some extent it is because the firm from sector M, they can only borrow from banks. Okay, so it's related to the question of Alistair. You have two types of financing: bank loans for sector M and bonds for sector I. So to some extent, there is a specialization of capital as well.
So you
Can you
think
go
of this.
back to the previous slide?
Sure.
There in this production function, there is KJ, but I mean it's, so J denotes, for example, YJ denotes the output
sector.
of sector J, right?
Right.
But he can only use, for example, if it's a small firm, only the informed capital, right?
Yes?
But then why do you put there KJ instead of
Oh,
A?
because we will look at the total, we're interested in the total output of the two sectors, and therefore we need to know how much capital goes to this sector. Okay? I'm not sure. Maybe maybe I have a picture. Oop.
So while you're drawing the picture, you might think about the question: how does this differ from a two country trade model,
Oh,
in
I
which
see.
you have production in one country, production in another country, labor stuck in the countries, capital is a tradable good because only one good model. It looks to me it's almost exactly like that.
Well, remember you have the banks that play a role. So
Well, the banks in one country are kind of like
You-
giving one
you-
country's capital and then the other country.
So you assume basically that the capital markets is there is a restrictions on capital movements, so capital has to stay in the country, or do you assume, because the rate of return on capital will be different in the different countries. In
Yeah, well, I guess that's my question. Does it fit into the two-sector trade model? I mean, there's some kind of.
I guess that if you assume that capital markets are segmented, that is, there are no, the capital is not free to circulate. I guess so, but I'm not entirely sure. I have to think more, but it's a good analogy. Okay, so the picture I want to, so you have, remember, you have the equity of the banks, you have the capital of the uninformed investors, and the sum of that is KT. The investors have the choice between putting their money in the bank in deposits or investing in bonds. The sum of equity and deposits represents the size of the banking sector, which is the capital provided to sector I, the small firms, the intermediate sector. B, the bonds corresponds to the capital that is provided to sector M. And then, once you have the equilibrium, so the two have a different interest rates. So there is I, or IT, and RNT. And once the capital allocation is decided, there is competition on the labor market to provide labor to the firm. Is that clear? I realize that now. So one of the features of the model is for the same reason as yesterday, because we will have this mysterious parameter B, which will determine the size of the frictions. Basically, the bankers extract a rent, and therefore the interest rate is higher. But the firms in sector I have no other ways to get financed, so they have to accept to pay a higher interest rate than the firm in sector M.
So can we think of these two sectors as like startup firms who do not have access to one market and then
For example, that's a good case. That's a good example. Another interpretation is small and medium-sized enterprises that cannot issue directly in financial markets. Okay, so bankers and investors, which I will sometimes call households, choose their savings and consumption levels to maximize expected discounted utility of consumption, and we take a log utility. And here, a bit like in the model that I was criticizing yesterday, I have to use this assumption that bankers are more impatient than households, than investors. And the idea is to fit, I mean, I'm not entirely sure of that, but I have the impression that we can establish that, for example, the dividend distribution, the ratio of the profit that is distributed as dividends is higher in the banking sector as opposed to other sectors. And this is a way to obtain this result. Bankers want to have more money earlier, if you like, and that would be a crucial source of inefficiency in our model. If the rate of impatience of the bankers and the investors or household was the same, the friction would vanish. And it's an assumption that is very classical in Brunner Meyer Sanikoff. I believe that Alistair uses it also. Yesterday I didn't have to use it, but yesterday morning I didn't have to use it, but for other models we have to use it. So investors are indifferent between bonds and deposits. So the rate of return on deposits will be the same as the rate of return on bonds. But there is this friction because bankers have to, at least to get some return on their equity, and they issue deposits to leverage their equity. Okay, which workers supply labor and own no assets. And for simplicity, we focus on the case where they are also quite impatient and they consume everything they get, so that in particular they don't save, because if they save, there will be a third state variable. It would be the capital of the workers on top of the capital of the investors and the capital of the bankers. So for simplicity, we assume that the workers are poor and impatient and they consume all their wages and they don't save for the future. Okay, is that clear? I mean, it's a restriction, of course, but so entrepreneurs are competitive and they make zero profit because of constant returns to scale. And the wage rate and the interest rate are determined by equilibrium in the capital and labor markets. Okay, so the first important thing is the bank leverage. Okay, so as I said, banks finance themselves by deposits and equity. And so the measure of bank leverage is the ratio of the total size of the bank divided by the equity. And the financial friction, like yesterday, exactly the same friction. So I hope you liked it. This is the return on equity, or basically the profit of the bank. So it's the intermediation margin, if you like. The bank lends KIT at rate RIT, and it borrows KIT minus ET at rate RDT. RDT is the rate on deposits, but at equilibrium, the rate on deposits will be also the rate on bonds to be the same rate. Okay?
So here again, banks maximize leverage?
So again, banks maximize leverage, yes. But they are constrained by depositors. Depositors are not ready to lend them so much money because they realize that otherwise the banks will not behave properly, or alternatively that they have to get at least sorry.
I think you just need to click on something.
Okay, so you see, this is the minimum rent that the bank have to hire, and this is what is left after depositors get RD. So this introduces a limit on leverage. So I'll come back to that later, and maybe the timing is useful. At the beginning of period T, you have these two state variables, the capital of the household, the capital of bankers. Then bankers collect a certain volume of deposits. The markets for capital clear in the two sectors. The labor market clears, production takes place, the commodity market clear, and people decide on their savings, which determines the future stock of capital in the two for households and bankers, given that there is some depreciation during the period. Okay, so I don't want to bother you with the detail of the model, but it has a unique equilibrium once again. So it's very simple to characterize at each period the unique intra-period equilibrium, so to speak. So for each value of omega and E, there is a unique equilibrium. And in fact, there are two regimes. There is a regime which is not very interesting, but like yesterday, we cannot neglect it. It's the regime where banks have so much capital, so there is a certain minimum function E mean of omega t, so that if banks have more capital than that, then financial frictions do not bind, they do not matter. In other words, the constraint, here this constraint doesn't bind, bank leverage is irrelevant, the marginal productive labor of capital is the same in both sectors, it's the efficient outcome. So if banks are sufficiently capitalized, frictions do not matter. However, the more interesting case is the case where banks do not have enough capital, and then financial constraint binds, leverage is determined by this. So there is a relation between the return on equity on the bank, which is basically the product of this factor B and the leverage. And this return on equity is determined by this, the classical formula, the leverage formula, if you like. You have a basic return, which is given by the bonds or deposit return, which is the same as the interest rate on sector M. And on top of that, thanks to your leverage, you guarantee yourself a higher return on equity, which comes from the spread, the difference in interest rate here. Okay?
And how does the threshold depend on omega?
I can show you that. I think I have a picture somewhere. Where is it? Yeah, so this is the, I will use it as a phase diagram later on. So there is in the omega E space, there is this curve here, if you like. So if you're below this curve, financial constraints do not bind. But as we will show later, in the dynamics, even if you start in this region, where financial frictions do not bind, ultimately you have to cross this dotted line, and the only steady state will be in the region where financial frictions bind. And it's very intuitive. It's related to our assumption that bankers are more impatient than investors. So in this region, in this region, bankers and investors have the same return because the interest rates are the same in the two sectors, so leverage is useless. So they get the same return on their capital. But since bankers are more impatient, they consume more, if you like. They distribute themselves higher dividends, and then ultimately you reach this region, and you stay there forever. Okay. So this is due to the assumption that bankers are more impatient than investors. Yes, you had a question.
Yes. So in this model, you're saying that omega is a source of funds from.
It is the size of the bond market, if you like, or something like that.
Yeah. So for example, if the Chinese invest massively in the U.S. banking system, omega increases. So
Exactly.
It pass to the nice situation in your model.
No, because if omega increases, financial frictions bind because there is not enough capital in the banks. So remember, we assume that you have to invest in a bank, to become a banker, you have to be an expert. So I don't know, maybe the Chinese are experts, but you can immediately buy US banks. So my interpretation of the savings glut is an increase in omega, not in E. So there is more money to be invested in the US markets.
What determines the split between deposits and bonds in the model?
Okay, it's the equilibrium. I don't know if you remember yesterday, but I wrote an equilibrium of the bond market and the loan market, and it was essentially determined by the equality of the rate of return for bonds and deposits. And this determined for a fixed level of capital, more precisely for a fixed level of E and omega here, it determines it's the equilibrium, if you like. It's what I was describing here. Maybe I was not clear, but if you want, I could write down the equations. It's not very difficult. This, determines endogenously lambda, the leverage. And since, so once you have the leverage, given E and omega, once you have lambda, which is basically KIT divided by E. So once you know lambda, you know KIT. Since the total capital is given by KT, you know KMT. And therefore, you know the rate of return, or MT, or IT, in the two sectors. It's the marginal productivity of capital in two sectors. And then you just have to check that this condition is satisfied. So there's a unique equation, basically, that determines leverage. And once you know leverage, you know everything. Okay?
So I think you have a table which shows how each variable influences after.
Yeah. So it is something, I mean, the comparative statics property, sorry, I'll come back to the other slide later, but it illustrates, so to be sure it's clear, let me remind. So here we're talking of the intra-period equilibrium, the period T equilibrium. And later we will look at the dynamics, because the competitive equilibrium is the whole dynamics. But we separate it into two. First of all, competitive equilibrium at day T, given ET and omega T, and then the dynamics of ET and omega T. Okay? So for the moment, it's the static equilibrium, if you like. So how do the capital allocation and the interest rates and the wages depend on E and omega? It's very simple. And we have this kind of comparative statics result. So for example, if there is a shock on TFP, if A decreases, the total factor productivity decreases, then bank leverage decreases, the volume of loan decreases, and the volume of bonds decreases. The size of the bond market increases, the size of the bank market decreases. If there is a shock on uninformed capital, which I interpret as a stock market or bond market crash, then everything decreases. Bank leverage, the volume of loans, and the volume of bonds. If it's a banking crisis, a negative shock on the volume of informed capital, then it's a different thing. Bank leverage increases and then decreases. Of course, it's a level. So, numerically or mathematically, since E decreases, bank leverage starts to increase, and then there is a deleveraging period where banks try to go back to normal, so to speak. But volume of loan decreases, volume of bond decreases. In all cases, of course, output decreases. So these are three forms of recessions, if you like, but they have different causes. And according to the cause of the recession, the technological shock, a banking crisis, or a stock market crash, the impact on the bond markets and interest rates are different. Okay? So let me move back a little bit. So one thing that we find is that bank leverage is procyclical. And this can be seen in this formula, tells you how bank leverage depends on factor productivity, total factor productivity A. And it turns out that leverage increases with total factor productivity. So when things go well, banks leverage more. When things go badly, banks leverage less. And this is due to our, what I call a skin in the game constraint. That is, you have to give a certain stake in the investments to the bankers, otherwise they don't do their jobs properly. And the stake that you have to give them increases with productivity. Adrian Enschin and Adrian Boyarchenko have a different story for the same fact, which is related to risk. And maybe this is what you had in mind, the notion that spreads are also related to risk. And here, it does not appear because there are no defaults in our model. Of course, this is a simplification. So the story...
The skin in the game is B. What's the skin in the game there?
The skin in the game is remember, you have to give a fraction BK of the return to the bankers. And this determines leverage as a function of productivity, if you like. So it's a bit more complicated than what I'm saying because the interest rates also depend on A.
But why do you call it skin in the game? Because it's only can give them a positive payoff. Skin in the game is when you're exposed to the downside. Here, it's like a rent. They get a positive payoff as part of the bank's benefits, but...
It's a rent, that's right. But in the back, if you like, a sort of micro foundation for this would be a kind of more hazard model where you can have idiosyncratic defaults, and then the interpretation is you give a bonus to the banker, and the expected value of the bonus is this BK. So in that case, that would be what you have in mind. But it's clear that since we did not specify the origin of this financial friction, it should be called a rent. You're right. As a minimum rent, you have to give to the banker, otherwise they don't do their job properly. And in some cases, it can be interpreted as a skin in the game. Okay, so what I wanted to say is that Adrian Shin and Adrian Boyarchenko have a different interpretation. They assume that banks are confronted with the value at risk constraints, and therefore, the higher the risk, the lower the leverage. And since risk is anti-cyclical, I mean, when things go well, the risk is lower, leverage is pro-cyclical. Okay, so that's the interpretation they give, and it's an alternative. Here we don't have any risk, in fact. Okay, so this illustrates the procyclicality of bank lending in the US, where you have the NBER recessions in gray, and they more or less correspond to the lower to the trough or the lower values of the size of the banks, if you like. Okay, so.
But you say they don't have any risk, but indirectly, I mean, if there is no risk, then the B is not justified.
Well, you could say that a very
popular
popular interpretation in the banking literature is, in particular, Diamond and Rojan and others, is the notion that you really have to prevent bankers from stealing the money. It's a current preoccupation. So you have to give them some bonus, otherwise they will steal the money. So it's better to give them rather than they steal it. So I mean, it's not really a risk. It's a behavioral thing or.
B for blackmail.
Okay, so let me skip. How much time do I have?
Let me
Sure.
there's a point here. It's like you've got the bankers taxing the sector that they lend to essentially.
Yep.
They've all got together
Yep.
and they've decided to
Yep.
levy this tax.
Yep.
And I think that the interest rate is higher in the boom states, so the tax is a fraction of the value of the assets or a fraction of the interest income is actually lower. So their bonuses are actually lower in the good state than the bad state, and what makes it particularly perverse is the bonuses are higher in the bad state.
Mm.
But there's also something odd about your model. Like a lot of people would argue banks expect a bailout, and what that does is lowers their cost of capital, and makes them lend too much in the booms.
Mm.
But you have the opposite going on. You have them lending too little all the time because they're taxing the capital in the
But
sector.
then
that they're operating
again,
in, and they
depends on
consume too
your-
much. You know, they starve themselves for capital to begin with by consuming a lot, paying a lot of dividends.
Well, two things. First of all, the benchmark should not be the efficient allocation, it should be the constraint efficient. And in the constraint efficient allocation, banks lend, if you use that as a benchmark, we have the result that bankers lend too much when things go well, not too little, right? They lend too much because of the financial constraint. Now, on the other point, so what was the other point? I forgot. Do you remember the second point?
The second point was that you were saying they lend too much, but when the question is relative to what, I was saying that the government.
Okay,
will still bail out
so
the
here
banks
again, there are no
because of
defaults.
capital too
So
much.
this type of things does not appear. But I agree with you that if we include a default, that might be an important thing too. Okay, so let me look at the dynamics. I'm more interested in the dynamics, but the static model, the static equilibrium is already, I believe, rich enough to capture important stylus facts. But now let us look at the capital accumulation. So the simplification due to the log utilities is that investors and bankers consume a constant fraction of their wealth at each point in time. And again, I make this assumption that bankers are more impatient than investors, which means that bank capital accumulates more slowly than uninformed capital, because bankers distribute themselves high dividends. And so this is the reason, I already commented on that, this is the reason why financial friction always bind for large C, because in the unconstrained region, if you gave the same rate of return on the two sectors, there was no spreads, then the capital of the banks would it would grow less fast, more slowly than the capital of the uninformed investors, and therefore this ratio would go to 0, which means that we would leave, this is a region below the dotted line here where financial friction do not bind, and the dynamics are really to leave this region after some time, and this is really due to this assumption that bankers are more impatient than investors. Okay, so this figure represents, it's a classical phase diagram, but instead of having capital and consumption, like in the Solo model, than in the Ramsey model, we have the two types of capital here. Okay? So there is only one state, so these curves, for example, correspond to the locus where the capital of the bank is constant. This locus corresponds to the capital of the uninformed investors, and the intersection of the two is a steady state. There is a unique steady state. It's stable, so the economy converges to this unique steady state. And the characteristics of the steady states are very easy to determine. Only depend on the parameters. And you can see that they are similar to what we get in the frictionless case. The frictionless case is the Ramsey model, where basically the interest rates in the limit are determined by the depreciation of capital and the impatience, the discount factor, if you like. The allocation of capital in the two sectors is determined by the productivities in the two sectors, so the specific productivities here, and also the interest rates, which are given by this. So this is a Ramsey model, classical Ramsey model, except that we have two sectors, but it doesn't really matter. In particular, the only thing that matters is the total amount of capital, E plus omega. But if you have frictions, then it's a bit different. The limit interest rate is the same in for the bonds market, or the market for the uninformed capital is the same. But the interest rate, the limit interest rate for the other sector is different. And in other words, there is a spread even in the limit. Financial frictions play a role even in the limit. And the spread is determined by the product of this term, the friction, B, and also the difference in the discount factors of the bankers and the households. So as I said before, you need both. You need both this friction here on the rate of return for equity, and on top of that, the difference in impatience. Okay? And of course, the capital allocation in the long run are determined by the same formulas in here, except that the interest rates are different, and therefore there are too little capital allocated to the small businesses because of this spread. The interest rate is higher in the banking sector than in the bond market. So let us look at the impact of financial frictions. So if you compare the two, you see, I already said that, they reduce the steady state capital stock in the intermediate sector, but not in the market sector. The spread between loan rates and bond rates persists in the limit to a combination of financial friction and patient banker. And friction reduce also the speed of conversions to the steady state. This I didn't show you the dynamics equation, but it's easy to see. Okay, so let us look at the impact of crisis. So of course we have calibrated the model to, I mean, I'm not a macroeconomist, so I don't know if but my co-authors are, so they have, I hope, carefully chosen the calibration parameters, but I don't want to go into that. So for me, it's more an illustration of how the model works. It's not a predictive power and so on. But we are going to consider three different types of crises. One is a bank crisis, a banking crisis, where the bank net worth E decreases to 2% of the total amount of capital. A financial crisis, where it's the investor's wealth that decreases by 2%. But I will allow myself to interpret that also, maybe you will not like it, but as a banking crisis followed by the bailout financed by a tax on investors. In our simple model, it's equivalent to a stock market crisis. Okay, so the idea is that the banks lose 2% of capital. The government say, oh, we cannot let that occur, so we give 2% of capital to the bankers and they tax investors in order to finance that. And of course, there is the red thing is the combination of a banking and a financial crisis where you lose 4%, 2% in each sector. Okay, so first element, bank recovery is slow after a banking crisis and fast after a stock market crash. Stock market crash is represented in green. It has virtually no impact on bank equity. By contrast, if you have a banking crisis in blue or a combined banking and financial crisis, well, there's a big loss. You see and it takes time to recover. And the big loss is due to the fact that the banking sector is relatively small with respect to the whole economy. So if you shock the banking sector by 2% of total capital, it's a big shock in relative terms for the equity.
Just mind, slightly confused by the titling of that chart because I can see the impact on the bank is very small, but I'm not sure the recovery is either slow or fast. It's kind of there seem to be extended dynamics.
Okay, maybe the wording is not perfect, but the shock, the impact is small.
So where do you see the size of the shock and the resulting?
So I said each of the shock, the green and the blue, correspond to 2% of total capital.
2% of bank capital?
No, 2% of K. So this is what I was explaining. In relative terms, since typically E over K is small, it means that there is a 45% shock on the capital of banks here.
So that's a very...
No, it's a big shock.
Like, even in bank stress tests, they don't say that, right?
No, but yeah, okay.
But
I wanted to have the same magnitude for the banking crisis and stock market crisis. And the same absolute.
In stress tests, they probably do a percentage of assets. And since banks are so highly levered, percentage of capital. No.
Yeah, but I mean,
I don't know.
In any case,
I don't know how to map this model into actual banks. If you should take assets as assets or assets as equity.
yeah, but this is equity. This
This
is
is
not
equity.
assets.
Okay, well, 50% of bank equity is a lot less in terms of the bank's assets. It's a tiny amount.
banks are not well capitalized.
How-
The banking sector is not
how
that
they
big,
are.
so.
And but there is no amplification effect here, right? So if the initial shock is, I don't know, 100 billion, you cannot have a total loss, which is a trillion.
Well, maybe not on bank equity, but on output, and I mean,
Output.
there will be. Let me show you, and then we can discuss them. So this is, for example, the impact on the wealth of households. So to some extent, there is some amplification here.
In this model, capital is the same as equity. Is that right? In this model, is capital the same as equity for the bank?
There's no risk weighting.
Sorry, I don't understand.
Capital is the same as equity in this model.
This has several meanings of raw capital. So capital is the total amount of physical capital that is invested in the economy.
But for banks.
And for banks have some equity and deposits.
It's the sum of
So are you asking, is it risk weighted capital? I don't understand the question.
No,
So-
It's actually assets and for the bank.
So what I
So
call,
in actual banks, equity is tiny and capital is big.
yes,
And the shock to capital and shock to equity are very, very different things.
exactly.
In this model, they're more similar. I don't know how much.
No, there is leverage. Leverage is,
How big is the leverage? I mean, that's.
in a steady state,
that's
it's
what
10.
Oh, okay, so it is not so different.
Okay, so maybe in terms of amplification, if you look at the impact on households, for example, in the case of a banking crisis, here is the bankers that suffer. So the households are not invested in the banks; they are invested in the deposit in the bonds. So initially they don't suffer, but then they lose a lot.
Okay, so the bank, for these parameter values, the bank capital is 100, the bank equity is 10.
Yes,
How big is the shock?
2% of 100.
2%.
2% of,
That's the,
no,
that's
not
something
the
different,
100.
the whole economy. That's
The whole economy, of the whole economy.
And so how big is that? I'm just trying, I'm trying to follow up on your question and try to figure out how big this shock is.
So here, the steady state level of capital is 11 for the total economy, and 0.5 corresponds to the equity. So
I think I just put, it's a 2% drop basically for the bank in their assets, lever that 10 to 1, it's a 20% drop in the banks. The chart shows a 40% drop, but that must be because
No.
the sector they're lending to, they're lending less to, and that whole sector is.
No, Pete, I think it's different. I think that the bank is 1/22 of the economy. You have a shock, which is 2% of the capital in the economy.
Right.
So that'll be
it should be
multiplied by 22, or about 44% for the bank. So you're having a hit to capital of 44% for the bank, is that right?
exactly.
Yeah, that's why I asked the question.
It's exactly right.
It's hard to-
It's
hard to
exactly
figure
right.
out.
2% of 12, let's say, is 0.24, and it corresponds to approximately 48% of the bank capital, 44% of the bank capital.
Yeah, so that's a huge shock.
No, I mean,
So
I don't want
I
to-
was wrong again.
I don't want to pretend that my simulations are realistic in any way. I want to illustrate qualitative phenomena. And the qualitative phenomena are in particular a very different pattern for the different types of shock. So for example, in the case of a banking crisis, the household initially are not hurt, but after that it takes a long time to recover.
So
Another
another issue is whether the model is quite linear or not. If you did 1% shock instead of 2%,
Yeah, so
proportionately it would look quite similar, wouldn't it? Or would it be very
that's
different?
more my question, like,
No, I don't think so. Why did you say that?
yeah, but anyway, I mean, your
no, I don't
assumptions
think
on
so.
leverage are pretty mild.
Sorry?
Your assumptions on leverage are mild,
Okay. Yeah.
because we're more like
Okay.
25, right?
But also the
Again-
size of the shock, can we look at the previous picture and the line of understanding there? So the omega shock is, okay, so that's happening in the other sectors. So this is so it doesn't have a very big effect on the bank, but the shock that you're giving the bank is huge.
Yeah.
Relative to the banking sector. That could be the difference.
Anyway, I mean,
The
I don't-
other thing that's qualitatively different, can you talk about a little bit, is that when there's a shock to the other sector, then initially there's nothing happening to the bank, it's only happening after that. And
Well, it
so-
has
so
to do
the
with
time pattern is different.
It has to do with the reallocation of capital due to the change in interest rates in the two sectors, and this take time. And the
That takes
rate
time.
of, yeah.
So
It's
if
such a
anything,
simultaneous-
the-
But
the
I'm not
big
sure it's
part is-
linear. You are seeing
No,
the interest of our
but-
model is that it's non-linear precisely.
but
You
can
can
you
simulate
explain-
completely.
But can you explain the title of this slide? I don't understand. So where is the stock market crash here? I don't see.
The green one.
But the green one is Omega. I thought Omega is bond investors buying bonds.
No, I shouldn't say stock market. I should say financial markets, because here the large firm financed by bond. I said bonds, but it could be equity. I mean,
Omega is like.
it's a financial market crash.
So the Chinese sell off their.
Yeah, I mean, I don't want to. Again, this is really a toy model, and I want to illustrate the qualitative effect. So maybe we should not interpret too much.
So I think the qualitative effect is that for the combined shock or the banking sector shock, it hits immediately and then it dies out. The
Yes.
other one hits gradually because
Yeah.
there's
It's
this
a
kind of
kind-
slosh over from the other sector.
Exactly.
And then it dies out. It looks like they both die out. Well, it looks like if anything, the banking sector shock dies out more quickly. But it's much smaller.
It's very similar. Okay, I don't want to spend more time. I just wanted to show you some pictures, and then we can talk about the relation with the real world. But for example, the households, you see that it takes a long time to recover. And they also lose, I mean, if you compare the green, which is the shock on the financial markets, and the blue, of course, they lose more from the green, from the stock market or bond market shock, but ultimately it's very similar because both are detrimental to their wealth and it takes time to recover. So this compares the output response, and we see that recessions are more pronounced and more durable after a banking crisis. Okay, so the banking crisis is in blue, and the stock market or the financial market crash is in green, and so you see that it's more pronounced and it takes more time to recover. Investors suffer a lot from crises. That's very surprising, but also it's quite durable, quite persistent. Workers also suffer from crises. So workers are only impacted through the wages go down in the two sectors. But they benefit from bank bailout. What I call a bank bailout is basically the difference between the blue banking crisis, where the government does not inject capital, and the green, which I interpret as a bailout of the banks financed by a tax on capital markets.
So you don't have any, you're talking about, you said workers benefit. I didn't see any welfare economics for workers.
No, here the workers, remember, they only consume, so their welfare is just the, so we have at the end some welfare computations that basically add up the consumption, the utility of the consumption of the workers.
Yeah, you look at consumption as well.
But this is consumption. Sorry.
Okay, yeah.
This is consumption. So you can infer from that the impact on the welfare of workers. I mean, are you talking of social welfare or the welfare of workers?
I just didn't see a workers' utility function.
Oh, it's utility of consumption. I mean, it's basic here because we assume that workers do not save. They inelastically supply 1 unit of labor and they consume what they have. So I did not even specify the utility function of workers because it's irrelevant. But if you take, I don't know, a log utility or any kind of utility function, you see that they lose a lot in the beginning, and after that they recover slowly. I'm not. There is something I don't understand.
No,
it's just that from that you can infer if you choose a utility function, and you can compute the welfare.
So, yeah, I was trying to think, are they less patient or more patient than the bankers? Because you haven't even.
So I assume that they don't accumulate wealth, they don't save. So
yes, you don't have to know their behavior. You don't have to know their preferences.
This means that they are quite impatient. They are relatively poor and they are quite impatient. So they consume everything they have.
There's no concept, definitely no concept of poverty here. Like, we don't know whether the workers are making $5 million a year or $5,000 a year.
What do you mean? So
The idea that workers are poor is not in your model.
I don't understand. Yeah.
The idea that workers are poor is not in your model.
Why not? I thought the idea that people are obliged to consume all they have and they cannot save for the future is a version of poverty.
They could be very wealthy and obliged to consume all they have. It's
Ah,
not
okay.
in your model. The concept of poverty is not in your model.
Well, I don't know the calibration. Forgot I mean, the wealth. Yeah. Okay.
Yeah.
I have to check.
Yeah.
To check the wages.
Well, as Pete says, that you're going to have a share and you have a representative worker. So the question is, how many are there?
No, sure.
And,
No.
and if there are a few, then they're very rich. If there are many, then they're poor. It's not.
No.
So what is your assumption about how a bailout is financed?
It's a tax on investors, on the rich people. So in my interpretation, the rich people are the investors, the people who put their money in the financial markets. And those people are taxed at a kind of lump sum tax, if you like.
I thought the rich people were the investment bankers.
No, yeah, sure, but you also have, no, sure. But as opposed to workers, that's what I meant.
Well, I mean, most of the tax base and much of the income in a modern economy is the relatively high-paid professional workers.
No, I mean.
That's where the wealth in the economy is.
Okay, so there's only, workers are homogeneous here in our model.
Right.
We could argue that maybe the workers in sector I are less well paid than the workers in the other sector, so that might be a response to your worry that you have poor workers in one sector and relatively rich workers in the other. So I have to conclude, I'm sorry, time is out. Yeah. We have strange things that we don't fully understand. For example, if you have a negative productivity shock in sector M, banks benefit temporarily from that, but after that there is a kind of overshooting. We have to investigate more. Let me conclude maybe. The thing is, bankers are not really hurt by pure technological shock. Workers are not hurt durably of pure technological. I mean, we can do all sorts of things. We even compute the welfare impact and impact on the spread. But let me conclude by saying this: two types of policy implications. First of all, banking crises have a much bigger impact on output and welfare than financial crises of the same absolute magnitude. Bank bailouts financed by taxes, if you accept this interpretation, reduce dramatically the welfare cost of banking crises. However, and this is the point I want to conclude on, recovery after a banking crisis, even if there is capital injection by the government, it's slowed down by the tendency of banks to distribute high dividends. So it's the idea. There was this cartoon about AIG where the Federal Reserve was pulling money into AIG, and in the back, the investment bankers or the traders were taking their money out for the bonuses, and it's exactly the idea. It means that it may be interesting to impose strict capital regulation ex ante, although in our model there is no need for a capital regulation ex ante because the market itself imposes a leverage constraint, and since there are no small depositors to protect, there is no need for the government to impose on top of that a higher capital regulation. However, there is something that the government should do, is to impose dividend restrictions on banks after a crisis, okay? So in other words, people are focused on ex ante capital regulation, but they are not so much insisted on the necessity to limit dividend distribution, especially after a bailout.
So how do you calculate the welfare effects of a...
Yeah, we have, but I'm not very happy with them because we need to check things. I mean, it's very preliminary, it's the work in progress. So I'm not very happy with those. I prefer not to show them because there is something weird. So we have to work more on this thing. Okay, thank you very much. Thank you.